Hello everyone, welcome to the 13th video of me learning how to trade using Forex. So in the last video we went through the fundamental analysis lesson in the forex.com, and we were going through the company analysis lesson. We got up to the company earnings bit on here, and we made some brief notes about the earnings report. So we got up to in the earnings report. I think we skimmed through the rest of this bit just to make the headers because we ran out of time last lesson. So yeah, let's carry on from where we left off, which is the income statement. So cash flow, income statement. So income statement. The company income statement is where a firm will report its revenues, costs, and net earnings. So, where a where a firm will report its revenues, costs, and net earnings, as well as various calculations of the business's profit. As well as various calculations of the business's profits for 3 months in a quarterly statement or 12 in an annual one. Income statements will often cover lots of different metrics. Most, though, will include the following. Covers lots of different metrics such as revenue, and that is all the money made in the period without any costs subtracted. All the money made in that period without any costs subtracted. Without any costs subtracted. Expenses. That is capital spent on earning revenue. Capital spent on earning revenue, including the costs of goods sold. Including the costs of goods sold. Net income. Total revenue minus total expenditure, also known as profit or earnings. Total revenue minus total expenditure, also known as profits or earnings. Earnings per share. Earnings per share. That is total profit divided by the number of outstanding shares used to measure profitability. Total profit divided by the number of outstanding shares used to measure profitability. Used to measure profitability. God, that's horribly wrong. Profitability. Gross margin. A measure of how efficiently a business is making sales, calculated by dividing net income by revenue. Net income divided by revenue, and that is how effective a measure of how effective a company is making sales. Measure of how effectively a company is making sales. So what is it? Gross net income divided by revenue. Net income divided by revenue. Revenue, all that money without any cost subtracted. How effectively a business is making sales. Interest payments. interest payments. The payments of the company is making on its short and long-term interests. The payments a company is making on its short and long-term interests. Gains and losses. Gains and losses. Any income or losses that aren't from sales or expenses. Income or losses that aren't from sales or expenses. For example, by selling some unused equipment. For example, by selling unused equipment. Other important metrics. You'll see these figures listed on almost any income statement, but there are lots of unique metrics in individual industries that may be important too. Investors in upcoming tech businesses, for example, may be more interested in user growth than revenues. Balance sheet. Balance sheet. The company balance sheet gives you a snapshot of everything a firm owns and owes at a particular period in time. So gives you a snapshot of everything the company owns and owes at a particular period in time. You can see when the snapshot was taken by looking at the date at the top of the report. You can see the date the snapshot was taken at the top of the report. The balance sheet will include a balance sheet will include assets, which is everything a company owns. Everything a company owns, including goods, properties and more. Including goods, properties, more. So that could be like the people working there. Liabilities. Debts or other claims on a company's assets. Debts or other liabilities or other claims on a company's assets. Shareholder equity. All the claims made by the company's owners or shareholders. All the claims made by the company owners or shareholders. Assets versus liabilities. The balance sheet gets its name because assets and liabilities should balance each other out. Right, so gets its name as assets and liabilities should balance each other out. In practice, that means the total of the liabilities and shareholder equity is equal to assets. Meaning the total of the liabilities and shareholder equity is equal to the assets. In this way, the balance sheet tells you how the business is paying for everything it owns. Assets plus equals liabilities for shareholder equity. How the business is paying for everything it owns. How the busyness is paying for everything it owns. Cash flow. The cash flow statement. The cash flow statement tells you how a company is generating the money it needs to cover its operating expenses, debts, and investments. How a company is generating the money it needs to cover its operating expenses, debts, and investments. You can use it to explore whether a business has sound financials as well as where it is spending its cash. Can be used to explore whether a company is making has sound financials, as well as where it's spending its cash. A cash flow statement will comprise of three components. Comprises of three components. Operating activities, any sources or uses of cash from the day-to-day operation of a business. Any sources or uses of cash from the day-to-day operation of a business. Investing activities. Any money used to invest in the long-term future of the company. Any money used to invest in the long-term future of the company. Financing activities. Cash from investors or banks, as well as money paid to the shareholders. Cash from shareholders or banks, as well as money paid to the shareholders. Money paid to the shareholders. Financial ratios. Financial analysis, fundamental analysis will often use figures from earnings reports to calculate rates which offer a quick gauge of performance. These may include financial ratios. So, ratios. Such as price to earnings, ratio, which is compares a firm's current share price to its earnings per share. Compares a company current share price to its earnings per share current share price. So current share price plus earnings per share, which is total profit divided by the number of outstanding shares. So for example, if a share is £10 and total profit, it generates £100, and there is 5 outstanding shares available, then 100 divided by 5, that's 20. So £20 earnings per share. Earnings per share. So 20 current share price. The current share price is 10 divided by 20, which is 0. Wait, 10 divided by 20. That's a half, isn't it? How much you're paying for each dollar of profits? You're paying half for each dollar of profits. Paying half a pound for each pound of profit. P is used to determine how expensive a share is when comparing to the money business you're making. So, earnings per share. Telling you how much you are paying for each dollar of profit. Telling you how much you are paying for each currency of profit. How much you're paying for each dollar of profit, how much, or pound or euro, how much you're paying for each pound of profit. P is used to determine how expensive a share is when compared to the buzz. Oh right, okay, so if you're paying £5 per share, but then they're only making £2, then you're a loss. You're making losses. But if you're only paying like £5 per share, but then they're making £10, then you're gaining profits. Right? Is that how it works? How much you're paying for each dollar? Tell me how much you're paying for each currency of profit. Used to determine how expensive a share is when compared to the money a business is making. Companies in different sectors will have vastly different PEs, so it is worth doing your own research to determine what looks like fair value for your chosen sector, and if a company hasn't yet earned a profit, then PE won't tell you anything. Note, companies in different sectors has different PE ratios. If a company hasn't yet earned a profit, then PE ratio won't tell you anything. Price to book. The price to book, meanwhile, compares a firm's current share price to its book value per share. Per share. Compares a company's current share price to its book value per share. To calculate book value per share, you minus any liabilities from the total assets of its balance sheet and divide that by its outstanding stock. Book per share, book value per share. Book per share is total assets minus liabilities, and divide that by its outstanding stock. So divide that by its outstanding stock. A higher ratio means that the markets value a company above and beyond its tangible assets. Higher ratio means the markets value a company above and beyond its tangible assets, such as buildings, machinery, inventory. This may mean investors price its intangible assets. This may mean the investors price its intangible assets, such as their brands, long-term contracts, patents, or customer loyalty. Prizes. Return on assets and return on equity. Return on assets and return on equity. Return on equity. Like PE, which is price to earnings ratio, these two ratios use a stock's total profit to evaluate performance. Uses a stock's total profit to evaluate performance. But instead of comparing it to the company's share price, they examine how it is using its assets and equity. However, instead of using its share price, comparing it to the companies, but instead of comparing it to share price, to the company share price, to the company's share price, they examine how it is using its assets and equity. They examine how it is using assets and its equity. Return on assets indicates whether a company is generating a solid return on its assets. Return on equity does the same, but for equity. Return on assets indicates whether a company is generating a solid return on its assets. Return on equity, oh no, the other one returns on assets. Return on equity does the same, but for equity, or assets minus liabilities. Both ratios are expressed as a percentage. Both as a percentage, and can offer an insight into how efficient management is at converting assets or equity into profits. Can offer insights on how efficient management is at converting assets or equity into profits. Other things to consider. Outside of an individual earnings report, there are several points you might want to cover when assessing an individual stock. These include copyright or patents. For some companies, such as those in software or biotechnology, copyrights and patents can be immensely valuable. Other points to consider include copyrights or patents, performance over time, which is a year or quarter's worth of figures won't show much. You'll get a much better view by assessing multiple reports across different economic and operating environments. Multiple reports, different economics and operating environments. Expenses versus gross profit growth. Expenses versus gross profit growth. If cost starts increasing at a faster rate than the profits, a company might be having problems controlling its spending. Costs start increasing at a fast could show a company might be having problems controlling spending. Wider factors. Earnings reports can tell you a lot about a business, but they won't tell you everything. Before you buy or sell stock, you need to take a look at some other data sources too. The number of areas you can investigate is practically limitless, but many investors simplify things by taking a top-down approach. So we've done that bit here. Start with wider economy. A growing economy is a huge benefit to businesses, so most investors will want to focus on countries that are performing well and avoid those in a recession. So a growing economy is a huge benefit to businesses. Growing economy is a huge benefit to businesses. So most investors will want to focus on countries that are performing well. Most investors want to focus on countries that are performing well and avoid those in a recession. Look at specific sectors. Now you can take a look at how a sector might perform overall in the upcoming years and months and years. Could central bank actions or new regulations harm this industry, or do you think consumer demand is set to grow? Compare the companies to its peers. After now analysing the sector overall, you should be able to get an idea of which companies are the big players and which might be the outperforming average. Using the ratios covered above can be particularly useful here, enabling to see how each stock is performing against its competitors. Test your knowledge. If Apple has EPS of $3 and a ratio and a share price of that, what is its PE ratio? PE is price divided by earnings, so 40. If Apple has a book value per share of that and a share price of that, what is its PB ratio? Price 120 divided by 5. That is 20. No, that is 424. If Netflix has earnings of 3.4 billion and an equity of 10 billion, what is its rate of equity? Rate of it is a percentage, isn't it? So 34%, because it's 10 divided by 3.4. Economic indicators and announcements. Economic indicators and announcements are an essential part of fundamental analysis. Even if you're not planning on finding trades using fundamentals, it is a good idea to pay attention to how the overall economy is performing. Here's a cheat sheet covering 6 key indicators and announcements to watch out for. So, economic indicators and announcements. Announcements are key. Are essential. Yeah, are essential. Six key indicators and announcements to watch out for. Non-farm payrolls. Non-farm payrolls. The non-farm payrolls report estimates the net number of jobs gained in the US in the previous month. So non-farm payrolls report estimates the net number of jobs gained in the US in the previous month. So estimates the number of jobs gained in the US in the previous month, excluding those in farms. Excluding those in farms, private households, and non-profit organizations Farms, private household, and non-profit organizations. It is usually released on the first Friday of the month. Usually released on the first Friday of the month. In an employment situation report. In an employment situation report. That also includes the US unemployment rate, which also includes the US unemployment rate. Average hourly earnings. And participation rate. Is there one for the UK then? Although its importance has dimmed somewhat in recent years, NFP is still probably one of the most significant economic indicators. Pundits from across the financial markets will attempt to predict the headline NFP figure each month, as well as potential market impacts. Why is NFP important? The Federal Reserve has to mandate to maintain maximum employment in the US, as well as stable prices, so they pay close attention to the NFP when setting interest rates policy. If unemployment looks strong, then they may consider raising interest rates. If it is weak, lower interest rates could be on the cards. Right, I see. So, important as Federal Reserve has the mandate to maintain maximum employment in the US. Therefore, as well as stable prices. Therefore, NFP is important when setting interest rates. If employment looks strong, then they may consider raising interest rates. If employment looks weak, they may consider lowering interest rates. As the US is the world's largest economy, any actions by the Fed tend to have a significant impact on the global financial markets. World's largest economy. Any actions by the Fed tend to have a significant impact on the global financial consensus. As with many economic releases, the markets will usually try and predict where NFP might land before the release itself. Usually, this is done using the average of a group of professional analysts. If NFP significantly beats or misses this consensus, a major market move may follow. After NFP release, major NFP misses. If it falls roughly in line with expectations, volatility may remain low. Other unemployment figures. Of course, NFP only measures employment in the US. It is also worth checking the employment figures for any economy you're focusing on in your trading, whether it's a change in employment in Australia or the unemployment rate in the UK. Consumer Price Index, ooh, CPI. So, let's non-farm payments, global market. Consumer Price Index, CPI. It's Consumer Price Index. Oh, we're nearly at the end of the video, so I'm going to do the same as we did in the last video. I'm just going to list down briefly the headings so we can carry on next time. So CPI, and then what's the next one? Central bank meetings. So consumer and business sentiment reports. Consumer and business sentiment reports. Purchasing manager index. Purchasing manager index. PMI. retail and vehicle sales. Why are they important? Okay, so other employment figures. NFP, well, is worth checking. So we should be looking at unemployment rate in the UK, or not just unemployment rate, but like an employment report in the UK. Right, okay. Well, I'm going to wrap the video up here today. Thank you for watching. I will join you guys in the next video where we go through the consumer price index, central market meetings, consumer business sentiment reports, purchasing manager index, and retail and vehicle sales section. So yeah, see you in the next video, guys. Bye bye.